Market consensus for Q2 2026 once pointed to a smooth cycle of interest rate cuts. This downward trending forecast has now hit a concrete barrier. Under normal conditions, an economy shifting into a labor supply surplus would lead the Federal Reserve to ease policy to prevent a recession. But those conditions have been disrupted. A geopolitical energy shock is now overriding the domestic labor data. After pausing rate cuts in January, the Federal Open Market Committee now faces an energy crisis that complicates any move toward easing. Effectively managing capital in Q2 requires understanding how these two opposing forces, deflationary labor and inflationary energy, interact to determine capital costs. While macroeconomic bears have predicted a wave of corporate layoffs, the data shows a different pattern. Layoffs are stable at 1.721 million. Rather than firing, companies are simply choosing not to hire. This bar represents the March headline non-farm payroll increase of 178,000 jobs. To understand why this number masks core weakness, we have to isolate where those jobs originated. Removing the 89,900 jobs added by the healthcare and social welfare sector significantly reduces the total. We also need to subtract the 35,000 workers returning from outpatient strikes, which further shrinks the core growth block. These roles are largely non-cyclical and do not reflect broader demand or growth in the corporate sector. Beyond the headline count, core indicators of labor demand are softening. Average weekly working hours have decreased to 34.2 hours. Average hourly wage growth has also slowed to a 0.2% month-on-month pace. With these distortions removed, the evidence points to a labor market past its peak. The period of aggressive wage bidding wars has cooled. This line tracks the February JOLTS data, which measures the ratio of job openings to unemployed persons. It is a primary metric for gauging labor supply. The 1.00 mark on this chart represents one job opening for every unemployed person. The ratio has fallen to 0.91. Crossing below that threshold signals that the labor market has shifted from a candidate-driven shortage to an employer-driven supply surplus. At the same time, the unemployment rate is stabilizing at 4.3%. This places unemployment above the 4.15% threshold, which is the estimated full employment rate of unemployment. In an assimilated economic vacuum, these metrics would typically lead the Federal Reserve to cut interest rates to stimulate demand. We must look past the domestic data to the physical constraints in the Middle East and the blockade of the Strait of Hormuz. Brent crude is now trading past $110 per barrel as supply routes face physical constraints. The blockade has also increased the cost of global logistics, making the movement of goods significantly more expensive. These factors drive cost-push pipeline inflation. Physical bottlenecks are forcing prices up regardless of the slowing demand in the domestic labor market. The Fed cannot cut rates to support the labor market if doing so risks allowing energy-driven inflation to take root in the economy. They can print money, but they cannot print crude oil. This collision of variables creates a stagflation trap, counteracting the deflationary relief of the labor surplus and making a continued rate pause the likely path forward for Q2. For corporate finance teams, the primary mandate for Q2 is protecting operating margins against these rising input costs. Now that wage bidding wars have ended, corporate leaders should prioritize freezing all non-essential hiring. Capital should be reallocated toward automation and robotics to reduce long-term labor costs. This pivot also requires significant investment in the physical AI infrastructure needed to drive these efficiencies. CFOs must be cautious about passing energy and freight costs onto the consumer. The middle-class consumer is already facing slowing wage growth and high prices at the pump. Attempting to raise prices in this environment risks a significant contraction in sales volumes. Financial markets continue to anticipate a Fed rescue, but portfolios should be adjusted for a higher-for-longer interest rate environment. This includes underweighting consumer discretionary equities, which are vulnerable as disposable income shrinks. Capital should rotate into short-duration fixed income to capture high yields without taking on duration risk. Commodities, critical infrastructure debt, and out-of-region energy equities are the most effective hedges against the Q2 stagflationary environment. With the Fed paralyzed, how is your Treasury team adjusting its capital cost projections for 2026? Let's discuss in the comments below.